I mean, if I take it from a customer perspective in terms of what they tell us is the benefit of sustainable financing, is that for them it's not actually the pricing benefit which is driving their decision to undertake a sustainable financing transaction. So they're doing it because the benefit they see is when they align their finance with their sustainability targets, then it drives such a great focus internally that they deliver the outcome that they wanted to. So that is their feedback on their sort of primary benefit, and then also it drives that sort of greater stakeholder engagement piece. So whether that's, you know, externally, capital providers, customers, but then also internally. So yes, pricing is a benefit, and borrowers will always take a pricing discount. You know, that's pretty obvious, but it does come at a cost to a borrower as well, because they have to be able to track and monitor and record and report to lenders and be externally verified. So it's not that it's a really easy option for a borrower to choose to have a sustainable finance product. So the pricing helps, but I think the true incentive for a borrower is they are already on their sustainability journey and they're already quite far sort of progressed down that track, and so they really want to accelerate their progress, and they know if they put it into their loan, then that will accelerate progress for them.
To me, it sounds like it's a commitment device, right? It's like you're signing up to this because it makes you committed to a particular thing, even when that leader might be gone, even when some things might change. So in fact, some of these contracts, these financing arrangements, these contracts can stand in for that commitment device for you to actually follow through on stuff that you want to do. So even when it becomes uncomfortable, you continue with it. And I think that's exactly what we want to do with InfraQE, is because we're the suppliers of equity, we're very committed. And we already have a commitment device because it's our members' capital, right? For a lender, it's much harder. And that's where the sustainability bonds are really unique, in that they create that specific commitment device for both the lender and the borrower to be on the same path to doing this thing well. The way I think about it is sustainable finance is a transition mechanism that essentially tells us that we're doing it wrong at the moment with our usual financing. So our usual financing is not putting enough pressure on the design to do the design well. We're doing wasteful financing, right? We heard from Seth that we are over-engineering projects. We are over-speccing our projects because the capital is available. The capital is not constrained to get the good outcome from it. But two, we're not thinking about the whole of life, which is what the sustainability stuff does, is thinking not just about the building of it, but the operations of it, because the incentives are mixed, right? The people who build it are not the ones who own it or run it. And so there is this kind of this coordination failure where the cost of building and the cost of owning and operating are split. And the beauty of sustainable finance, it lets you see through the whole thing, from getting the design right, the execution right, and the operation of it right. At the moment, finance as it stands does not do that. So I don't know about you guys, but I know the green finance, sustainable finance of total lending in New Zealand is pathetic, right? I think that's the technical term for it. But the value of it is not the size of it, but the fact that we're getting this valuable insight that there is a different way of doing things for not just the green bonds and the sustainable bonds, but for the usual lending that we do. It's about infecting general practice. That's really what's valuable. And I think it's going to be particularly important in a world where there's a huge amount of backsliding going on when it comes to the climate change situation, right? Both globally and in New Zealand, we're seeing this massive pullback from our climate commitments. It's embarrassing, but it's happening. But if it turns out that the money guys tell you this is a better way to do it, it's going to happen regardless of whether government does it or not. So it provides a commitment mechanism and a long-termism that I think is different. And it's an antidote, I think, to the short-termism of politics that we're seeing. But in my view, if we want sustainable finance to be successful, we want it gone within the next decade, and we want it to be normal practice, BAU.
Where we really need investment is in that transition piece, in that space where we're, transitioning assets from brown to green almost. And I think where we're lacking is there isn't as much guidance in the sustainable finance space to give investors comfort investing in those assets or lenders. So, and there's some that's coming out. It's, that space is growing slowly, but if we're going to meet our emission, Paris Agreement, we have to transition these assets. And I think, you know, potentially with, you know, a reduction in CapEx available in the local government space, we might see more of that. You know, we might see them opt into take more of a retrofit perspective in their current assets rather than investing in new assets. And certainly from our perspective, you know, we're already geared up to support and finance those types of assets because we see the real value in them. But I really do think that is the space that really needs to grow from a sustainable finance perspective. Otherwise, we're just not going to meet our long-term goals. It's not going to happen.
The KPI should be based on the strategy and the direction of the project, as opposed to the KPI shifting the decision. So really you would undertake sort of a materiality assessment of your project, and you'd determine what are your material factors and what are you looking to really make an impact on. And then you would structure your KPIs around that. And I guess I would just say in terms of infrastructure projects, so by the time a project comes to a bank to finance it, it's been developed and planned, and you know, the banks don't influence that. And so the drive to create something to be sustainable comes from the banks in terms of it's what we think should happen, but also it ideally needs to come from when the project is initiated, that the project is actually looking for the project to be sustainable and therefore are encouraging the lenders to provide sustainable financing opportunities.
The difference with equity investors versus bond suppliers is that you are there for one part of the risk, whereas when you're the equity supplier, when you're the owner of the asset, you can't run away from it, right? So you are very strongly incentivized. And I think even there, like if you look at the performance of our local governments, for example, in the last 40 years, we have failed to maintain our own assets. So even when you're the owner, if you don't have the right structures of governance, you can have massive failures. So it's a long-winded answer, but I think there is a real role here in terms of the standards, the information, the consistency. All of that stuff is really important, but it has to come with accountability. And accountability, when it's self-reinforced or self-enforced, doesn't really work. It will never become big enough. And this is why we keep on trying to get government and regulation in there, because regulation is the big stick that creates that backstop, right? So you don't change. So when we're thinking about things from an InfraQE side, it's very much saying that, look, if we want to own this asset for a long time, it has to be sustainable, because otherwise it'll be a financially bad bet. And so our actual motivation is financial returns, but within that is captured all of those, I guess, sustainability goals that we would have anyway.
I think just going back to the point that Helen made also around how sort of local central government plays a bigger role within this space also, you know, not necessarily, you know, in Australia there's obviously a lot of government capital that's been put to work within transition. You know, some of our balance sheets here are clearly a bit tighter, but probably the emergence of blended finance structures is something that I see as being a real unlock in this space as well, where we get looked through to some of those government counterparties or local council counterparties without them necessarily having to put the capital on the table, and they become more of an enabler of private capital, starting to to do the work around the funding side of it.
Where do you see, building off James's introduction as well, where do you see the role of organisations like Tonkin and Taylor and others who are, you know, often involved earlier in these projects?
When I work with the best engineers and planners, what I find is they come with a less engineered, more efficient, cheaper outcome. So the experts are very good at saying, no, you don't need to have a 13-meter wide road. You can actually have an 8-meter wide road. Or you don't need 4 bridges, you only need 1 if we just designed it this way. So that partnership amongst experts, I think, is really important. But so much of what Seth described was essentially when you learn from the good projects, you can then bring them into your general practice, not just a sustainable project, but every project. It's that learning that's so important. And I think that's what happens in the scientific community, right? That's how science is done. I think sometimes finance doesn't do enough of that. It's not fast enough because the incentives are to make as much money as quickly as possible. So it's a little bit different there, right? So, but when you think about the technical experts, I think it's really about making sure that we are always finding ways to do things cheaper, faster, better, right?
And I think modernise is a really interesting word to use here, because I think in this space I'd more so use the word ambitious, and you know, how are we delivering those additive outcomes that we see. You know, we're not in the infrastructure space just replacing like for like, and we're not just going with what we've known because it's comfortable and it's easy to measure and it's easy to evaluate from a financing and kind of government sign-off perspective, you know. So I think it's about how do we innovate in this space and become, you know, more ambitious in our planning around what infrastructure looks like for New Zealand. And I think I'd say, you know, we could have better criteria, you know, global standards could help drive it, but ultimately we have the ability to drive that ambition. But I think what is key, and I said this at the start, is really having stronger relationships between lenders and the infrastructure providers to make sure that we are appropriately driving the right outcomes to modernise infrastructure. And you know, I've seen the value of doing that with the local government sector, and we're seeing that play out now as a result.
There is no unicorn costless solution. There will be communities who will lose and communities who will have to just shut down. So that is the unfortunate reality. I think quite often when we have conversations of adaptation, we talk about it as if there is some kind of magic solution where every community as it stands can survive. I don't think that's true. And that it can be costless. It won't be. So either the cost will be borne individually or will be collectivized through central government. There's only two options that are available. Local government in New Zealand is too fragmented, and they have too much concentration of risk for them to be able to manage it in most cases. I'm sure there'll be some examples in some other place where it's possible. But the reason I'm just mentioned that is because essentially what we're looking at is a great transfer from one group of people to another. And who's the best place to do that? Is KiwiSaver well placed to do that? Absolutely not. That is not the role of private equity capital, right? That's what KiwiSaver is, people's retirement savings. It cannot be put to that use. Fundamentally, I think it has to be backed by tax, it has to be backed by central government, and I'm very concerned that we are not prepared for the things that are coming at us very quickly. So I'm very, very concerned on this one.
What I'm seeing at the moment is councils working really closely with their communities, because they're the best place to understand what is the actual need, and then they become the facilitator of that to create a solution that, yes, may be funded by the community themselves, but they are actually the best place to say, this is what works for our community, this is how we can make it work. We can take on that risk of, you know, purchasing the land or whatever it might be, but it has to be funded from elsewhere. So I think the role of local councils is arguably even more important than the role of central governments when it comes to adaptation.
This is not to diminish what you're saying at all, Helen. I think it's more the realism of where local government politics is going in New Zealand, which is on a fast track towards centralisation, which is even greater centralisation than we've had. Pretty much the reforms of the 80s was designed to weaken local government, and those results have been born, and we can see it, right? Rates have been not going up fast enough. Our assets have been run down. We have too much debt. All roads lead to central government interference in local government in the future. So this is not, it's true that if you wanted to get better solutions, you do it at the community level in a more devolved way, so we could get right-sized solutions where the beneficiaries bear the costs. But that is not going to happen with where the current setup of governance is going in New Zealand. So that was my concern, is because of this trend towards centralization, I think we will not be able to right-size the local solutions, and instead we'll have this one-size-fits-all, centralized, top-down driven thing, which is going to create big winners and losers.
I think, you know, one of the key factors is how we view the benefit of sustainability, you know, in inverted commas, in terms of risk and capital allocation. At the moment, sustainable finance will be a basis point discount on a generic loan, but we're not really baking the benefits in terms of risk and long-term performance into our base capital allocation. Like RBNZ's looking at climate risk weights, etc. But I think that is when you really start to distinguish between those assets that do have those long-term characteristics. And, you know, when adaptation comes, when climate change comes, they are going to be more resilient. They're going to provide better, longer-term, stable outcomes, and that they turn up in our risk models and how we think about that allocation and pricing in capital, like we do in our sort of normal book to a widget maker. You know, we'll have metrics there that are very financial in nature, but we're not really truly embedding some of those sustainability coordinations in that pricing allocation of capital right now.
So essentially my view is that we should not have specific New Zealand standards, we should have high quality international standards, so then it's completely fungible across markets. Most of our money is invested across the world, and we want to be able to do that in that scope. We shouldn't have some kind of shitty second-rate New Zealand standard. The way that I think about it is, when it comes to sustainable finance and how we make progress on this, it's three things: gates, ladders, and unity. So gates is about saying no to bad projects, which is where the standards and good information comes in. The ladders is really pushing along on the projects that deliver those returns well, so go hard. But the unity part is where it's really important, is where how do we make sure there is enough knowledge across both the purchasers of the projects, which is going to be us as InfraQE, but also the people who are doing the work. Right, so it's that unity part. I think that's where there's a lot of gap and work to be done. This is the transition phase for us. I think this is the time that we have to work really hard to go make sure we all understand what good looks like, what bad looks like, and how we go from bad to good.
So it's an interesting one, because I guess we have, if we're going to develop these programs, we have to meet global market standards, but we can also then raise the level of ambition from that baseline. And so I really think the opportunity is looking at, okay, what's best practice, or what's the type of behavior and type of infrastructure that we want to incentivize, and making sure that those programs reflect that kind of key criteria, and also reflect the New Zealand context as well.
Yeah, I mean, I think for infrastructure projects, the Infrastructure Sustainability Council, the ISC ratings, that's a really helpful tool, and that is something that could be incorporated into sustainable finance. So, similar to what we've seen in the green building space, the council ratings, that makes it quite a simple product to offer, because there is a clear rating there. So I think there are tools out there that could be used. We haven't seen the sort of transaction flows really increased in the space. As to the reason for that, it's sort of, I guess, slightly unclear. But I think there is a lot of development that is going on, and this is what makes sustainable finance such an exciting space. It is constantly evolving and innovating. So I think that the more these sort of measurement challenges are solved, then we will see, this product opened up to more sort of sectors. I don't think there's one in particular that is going to be the next cab off the rank, but I think, you can even see it like, not infrastructure related, but in the agri space, the forestry, land and agricultural guidance that has been issued has opened up that space to tracking emissions, which didn't exist before. So it's constantly evolving, and I think, as the tools improve, then sectors will take on this opportunity more readily.
I think in terms of future willingness, it's as we build better data around outcomes and performance of these assets, and we start to evidence the design principles that are going in up front. I think there's no shortage of willingness from banks to lend into these types of asset classes, generally large lends to well-rated counterparties. So I think it is the repeatability of it is going to be all around how we quantify those ongoing benefits, not just in terms of dollars, as we mentioned earlier, but those real outcomes. And to the point around longevity of these assets, and if they are going to, be 10% more expensive to fund, and that comes through to debt, that we are able to evidence the benefit of that going forward. But I guess the major point is this is certainly an area that the banks are very keen to lend to.
Right.
It sounds like the lesson for us is both around what we lend to and what we don't lend to. right? It's partly about learning not to build on floodplains and not doing stupid things, right? And finance has a real role to play as a gate to say, no, we can't finance that because it's an unreasonable amount of risk that you're taking on. And yet we see many of the projects that do go ahead bear an unreasonable amount of cost because of political convenience, of egos and that kind of thing, right? So I think that's what Fran was talking to, I think, is that there's a coordination problem here. The incentives are misaligned and finance can't do it on its own. It's kind of at the intermediary space, but you need to have the people who are commissioning the work, people who are owning the assets, to also have that long-termism baked in. Otherwise you get this misalignment of incentives and it just doesn't work.
Yeah.